Good morning, folks. Hope everyone's having a good start to the week. Happy Taco Tuesday to those who celebrate. The second week of this government shutdown, markets don't seem to care much about that. So we're going to keep doing what we do, which is looking for opportunities to capitalize on these markets and the situations that are playing out on multiple time frames. It's really what it's all about. Trading whatever market's in front of you, whatever our predisposition is to think it's going to do, we got to kind of set that aside and see what the market actually wants to do, following the momentum, letting the macro set the trend for the bigger picture, but not the everyday back and forth. So, folks, remember when you're trading, not to risk more capital than you need to, than you feel comfortable with, than you're willing to lose. For most people, that's going to be about 1 to 2% of their total portfolio. That tends to be a pretty good area to say, okay, I'm putting some capital at risk. It's worth watching the trade. But at the same time, I'm not putting so much at risk that I might make some really bad decisions here. And that's really one of the key parts about risk management is you want to make sure you're running your trading more like a business. That means you're not dressing it up to be something it isn't. It's really buying and selling inventory. Those are stocks, futures, options, commodities, whatever it may be that you're trading, and looking to capture a positive spread repeatedly. That's the foundational goal of trading. And then if you're not putting so much capital at risk that it puts to risk whether or not you're going to be able to keep trading, then you have the opportunity to come back. If you're wrong, you're wrong. If you're right, you keep leaning into those trades. And you got to be accountable to yourself. A little bit about me. I've been doing this for 20 years, and one of the reasons I'm still around is accountability. I keep a trade journal even 2 decades into my journey because I'm realizing there's always more to learn and improve about how we approach the markets. That's one of the things that I learned going through the great financial crisis that stuck with me is really risk management is so important to your process and being accountable to how you're managing risk, how you're executing. So I keep a trade journal, and the way that I look at that trade journal is pretty simple. I'm recording what I'm buying and how I'm buying it. Am I going in all at once and I think I'm smarter than the market, or am I going in tranches, scaling in and out of that position if I have a chance to scale out, if I'm not stopped out? What is my mindset when I'm taking that position? Am I excited? Am I feeling a bit greedy? Am I scared? It's important what your mindset is. That can define where you're in your sweet spot psychologically. For me, I try to have as little emotion as possible. I'm more of a systematic trader. So I also like to talk about what kind of signal fired off. Was it something I'd been back testing? Was it something I was looking at based on a different data set? Was it based on a model? Why am I getting involved in that trade? Because then when you go back through your journal and your P&L, you can see which of those trades that you're taking are working and what kind of patterns they fit into. You can start to identify your weaknesses and your strengths as a trader. And that's really, really, really important. That's probably one of the most important parts as to deciding whether you're going to survive. Why do I say that? Sounds kind of dramatic, doesn't it? The reality is most people don't survive this game. The shorter your time frame, the shorter the duration you may have as a trader. But it doesn't have to be that way. That is to say, if you put effort in to trying to manage your expectations first and foremost, if you're newer at this and you think I'm going to get really rich really quickly, set that aside. It's not realistic. It's much more important to look at this as a journey to a destination. The destination being, we'd love to reach a higher level of financial independence. I'm sure that's why a lot of people get involved with trading, to create another income stream, to learn another skill, to make money. But in order to make money in anything that you do, you have to have reasonable expectations. If you're not patient with yourself and the process, then you're not going to get to your destination. So I like to tell people to enjoy the process, enjoy the component of trading that is getting better. At first, you're going to have losers and you're going to have to deal with them, whether that hurts your ego or not. In fact, it's probably better that it does in a way. That is to say, we don't want ego in the driver's seat. We want objectivity in the driver's seat. We want a system driving those calls. Now, at first, it feels really good to be loosey-goosey, discretionary, just trading off charts. And for some folks, that works just fine. But for folks that I know that have been doing this for a longer time, that have achieved higher levels of consistency and really rely off of trading, folks such as myself, systematic approach tends to be better because you really remove a lot of the guesswork and emotion from the game. It's not how are you doing that day, it's how well are your systems able to identify signals that are actionable. And you can take some of the guesswork out of that. You can even add some layer of automation if you're so bold. But at the end of the day, having a systematized approach allows us to be a lot more objective. We're really trading the market in front of us. For me, I like to focus on momentum, options flow and positioning, some of the key price action, like looking into what the kinds of patterns that can lead to bottoms and tops and continuations and consolidations. I think it's important to look at sentiment and positioning. Sometimes you'll see that there's risks that you wouldn't see in the chart in how crowded something is or how excited people are about it. So for me, it's kind of a blended approach. I would also say for trading, especially right now where the equity markets at the index level have been just a little bit more boring for a lot of people, really, really important to consider expanding your horizons. But that doesn't mean just go out and trade whatever you want willy-nilly. It really means look at some of these other asset classes where they might have personalities that are compatible with your trading style. What does that mean? So every single asset class, even different stocks, they trade differently. They have their own personalities, which is really cool in the sense that you may find that certain things you didn't even think you knew you could trade or you were good at trading end up being some of the vehicles you really enjoy trading. I'll give you an example for me. When I first started trading back in 2005, I was mostly trading commons. I was mostly just trading stocks. And it was fun, and I made some good money. But in 2006, I started trading gold, and I had a ton of fun with it. I never thought I'd be trading gold. I didn't even think, when I got into trading, that would be that interesting to me. Because the first trades that I ever did were in the late 90s. It was Amazon and Yahoo. It was during the dot-com euphoria. Each one basically doubled within a matter of days, and that got me scared. I actually got out because of how fast they were moving. It didn't make sense to me as a young person. I didn't come back to trading until 2006 when I had more time to learn, to save up some money, so I was trading my own. And I just didn't think, hey, I'm going to want to trade commodities in the future. But in 2006, the way gold was moving really made sense to me. The way I was trading was very much driven by momentum and momentum only back then. And so I started trading gold more, and it was a ton of fun. Not only did I learn a lot, but I also got the sense that at least the way that gold was trading in that regime, that it was pretty compatible to how I was wired at that time as a trader. And so I traded gold for years after that. And I was still trading stocks. I started trading equity futures. I traded options more, but I always kept coming back to gold. And I had some of my best trading days trading gold back then as well, because it just made sense to me. And this was when I was more of a discretionary trader and I was eyeballing things and kind of learning my lessons as I went. And then came the great financial crisis, which was a pretty remarkable time to be a market observer of any kind, whether you're an investor, a trader, an analyst, just kind of being a fly on the wall as the plumbing of the global financial system came unglued. What better way to learn about how it all comes together when it's all laid bare in front of you? And so I did. And that gave me a really, really strong appreciation for risk management. Because if you're not managing your risk when the market's moving like that, you're just simply not going to survive. You're going to get absolutely ground into paste by the meat grinder that the market had become. Yes, it was a violent bear market, but here's the thing about violent bear markets: you can't just short them blindly, particularly not into the hole. That 2008, 2009 decline, it was like all of 2008 with fits and starts, and then the first quarter of 2009 when we bottomed. There were periods where you had absolutely rip-roaring rallies in the S&P and in the Nasdaq and in some of these stocks and sectors that were beaten down, like the financials, the banks. So you couldn't get cute with your shorts. You had to be nimble. Even in the greatest financial crisis of my lifetime, which would have, on its surface seemed like, okay, all you do is just short, hold your nose and make money. It really wasn't wired that way. The way it was wired, what I learned about it and what I built a system around was fading the reflexive bid into central bank interventions. Because what I had noticed is up until FASB suspended mark to market and we had mark to make believe in early 2009, the easiest thing to do was to fade the ephemeral or short term market reaction to intervention. So, it would have seemed, again, during the great financial crisis, it would have seemed like all you do is you just short and you make money. But the reality was you had to reoffer when there was this reflexive bid into a stick save, like the Fed doing an emergency cut of 50 bips. The market would rally 5-10%. It would start to lose its momentum, and you could build a short position into that, scaling in. So the reason I mention all of this is I wasn't wired for any of that going in. I hadn't really been through a bear market before. And when I went into the great financial crisis, my expectations were skewed because if you zoom out on a bear market, it just looks like a jagged line down. You don't really appreciate how much these things can rally. So the point being, the next time there is a bear market and you think, hey, well, all I need to do is just buy puts or short, be mindful of shorting into the hole. Be mindful of offering into periods of time where the market looks like it's having a relief rally that ends up being a lower high. Because when you zoomed out on that late '07 to early '09 chart, a lot of it was simply lower highs and lower lows, negative momentum on a much longer term chart. And that made it easier to recognize where those reoffer zones could be as well. So all that is to say, know the regime you're in. Trade accordingly. We are in a very unique market environment right now. It is one that is extraordinarily forgiving in some of the prevailing narratives. Companies that eventually probably won't even make any money. A lot of these quantum stocks fit that bill. Some of the more loosey-goosey AI stuff that's pre-revenue. There's a lot of stuff underneath the surface here that's more risky. It doesn't mean it can't keep going up, But in the back of our minds, we need to kind of be ready to understand this is a game of musical chairs, and eventually the bottom will fall out on some of these narrative driven names. The really big companies that have benefited, that have actually grown earnings, that have actually grown revenue and build new businesses and new products and services lines, and those are growing, that's a whole different story. They're not experiencing the same kind of narrative driven bubble that some of the pre profit and pre revenue companies are. That's where the danger really exists in my mind. At least that's the greatest danger. Although you will see that the AI story is becoming a little more circular. You've got Nvidia investing in OpenAI investing in AMD, and so on and so forth. So that does create some level of interconnected risk as well that's at least worth keeping in the back of our heads as we approach these markets. So let's move on to the weekly pivots real quick. I want to share those with you all because I think they're pretty important. These are derived from options levels. These are the bullish above and bearish below pivots that I'm looking at when I'm watching the markets here. And we're just testing those pivots. ES were above, NASDAQ were above, so it's looking pretty bullish. And I'm just going to put these out on social real quick. And really not a lot going on into the economic calendar. If we look at the calendar today, it's really full of Fed speakers. Got Bostic at 10, Bowman at 10:05, Moran at 10:30. Then Trump greets Canada's PM Carney at 11:30. We also have Kashkari speaking at 11:30. There's a bilateral meeting between Trump and Carney at 11:45. Some ECB central bank speaking around lunchtime. Trump has lunch with Carney. And then there's a 3-year note auction at 1 p.m. So all the data that we, used to get that would sort of set the tone, a lot of that is on pause as the government is shut down. So that leaves the market with a little less to be nervous about because there was some growing consternation about the labor market. So going into this week, the market has more reasons to sort of levitate higher because it's not keeping its eye on some of the risk factors that are starting to build up in the labor market. So that's something to keep an eye on just in the tone of what we could expect trading this tape. It's more likely to just levitate higher and grind sideways. And the two ways that I like to kind of evaluate what the potential are for those scenarios in the first hour. A, the 20-minute opening range. How big is the spread between the high and the low? And B, the options flow. Where are we seeing that distribution? Is there one side that's lopsided between calls and puts? And what's the delta between the most active strikes? Between the opening range and the options market generated information, we can get a better sense as to whether we may be seeing an up day, a down day, or a consolidation day. For the opening range, you're really trying to see an opening range that sparks some degree of excitement. I like to see 15 handles or more in the S&P. A lot of the boring days are days where you get 10 handles or less on a 20-minute opening range and it just sort of chops and it's not very directional. You get a larger opening range, you have more room for dynamic price discovery. On the other side of it, when you're looking at options generated information in the S&P 500 index, the distribution of the most active strikes can give you a sense as to A, which side might enjoy an advantage, and B, the difference between them gives you a sense as to what range we might experience. So you take all that information together, and the opening range and the size of the difference between the most active strikes can give you a sense as to how volatile the market can be and where more volume is transacting. If there is an imbalance in the calls versus puts, can give you a sense as to which side might have an advantage. So those are the things that I really like to look at going in, because it gives us a sense for short-term trading where there might be an edge we can lean into. Now, real quick, I'd like to share some exclusive deals with you all. If you'd like to get up to 40% off of Bookmap, bookmark this URL, traderade.com/bookmap. That's traderade.com/bookmap. You can scroll down to the special offers and get up to 40% off. Now, speaking of Bookmap, we are going to dive right in here with it on screen. So we've got the S&P 500 futures on screen. We're just going to do a little bit of a walk around some of the futures markets as we approach the market open. So first with the S&P, let's zoom out a bit. We can see the overnight session pretty much chopping in a range. You'll note last night after the market closed, we reopened in Globex. We saw some pressure and we made a low. Then we took out that low by just a hair. Strong bid came in. Now we're pushing above yesterday's highs, really set or pretty darn close to open this market at new all-time highs. We do see some iceberg buying coming in at 112 contracts bought. But overall, the way that this market traded overnight gives me a sense that we've kind of flushed out some of the weaker hands. The short-term traders have probably got stopped out by some of that weakness, the ones that didn't have much risk tolerance to begin with. And shaking out those hands probably gives us some potential to make a push higher during today's trading. But of course, we're going to watch that 20-minute opening range and how some of these options trades are going in SPX to get a better sense as to how that may all take place. So we're going to then take this back to a 20-minute time frame. We'll do the same look back at the NASDAQ here. NASDAQ getting sold off from its recent highs, but it actually has a pretty constructive look about it this morning. Made a much bigger push in the S&P. And so you can see a similar look overnight. You have this drop into the Globex session. Got back close to the top of that range, close to the point of control, dropped back down, made a slight, close to a new low, not quite like the S&P. And then from there, it's been just pretty aggressive buying. You can see recently some of this volume on the buy side delta has been the most aggressive in the last 12, 13 hours. So NASDAQ also seems like it's set for a more constructive day. Let's take a quick look also at the pre-market heat map as we get closer to the open here. And give me one moment. I just need to set this to allow me to put things in front of it. There we go. And so this is the pre-market heat map from FinViz. You can see some strength in AMD, some strength in Micron and IBM, but overall relatively green. Some exceptions including Tesla, Google, Johnson & Johnson, but overall the market looks like it's got a decent little bid heading into the trading day today. And it's a pretty widespread bid across multiple sectors and industries, which is healthy. That's a good thing to see ahead of the trading day. Let's take a look at gold. Gold just really, nothing can stop this thing. We talked about $4,000 an ounce gold really as a possibility this year. We talked about it last year. And it's happening. And we're likely to see this continue. Gold moves for a lot of reasons. It moves because the money supply is growing, although the correlation there is a little more tenuous, but it also moves because there's uncertainty. Uncertainty about the economy, uncertainty about geopolitics, uncertainty about policy, All of these uncertainties have helped gold have such a powerful rally over the last year and a half, 2 years. And I'm not so sure that rally is going to end anytime soon. Gold and silver both have had such an incredible run, and there's so much feeding it. We have fiscal excess. We're just spending on the deficit side of things very, very aggressively. And we have monetary easing feeding into the appetite for gold as interest rates go down and some of the fixed income competition for gold diminishes. So I'd say gold's in kind of a sweet spot here. I would look for this to continue higher. You know, I've been pretty adamantly bullish about it for pretty much the last 2 years at this point. This is the time that, gold tends to really thrive when there's also another factor at play over the same period of time, by the way. I'd be remiss not to mention Russia's war in Ukraine and how the US and Europe using the Western financial system as a weapon against Russia caused central banks around the world to want to hold less dollars, dollar denominated assets, and want to diversify into gold. And so central banks have been extremely aggressive buyers of gold as well. And that trend is not letting up. Retail is starting to buy more gold. You're seeing institutions diversify more into gold. It's a really powerful set of catalysts. So while we hit this milestone of $4,000 an ounce, we might pause and consolidate a bit. There is certainly some room for that after the run that we've had. But I think we still have quite a bit more room higher. We're still in this Bollinger Band squeeze breakout. And that's where the volatility of price continues to rise as the price itself is rising in this case. Can go either way with the price, but this is a breakout to the upside. And you're seeing similar in Bitcoin. Bitcoin making new all-time highs. That's another sort of dollar debasement trade. You're seeing this in silver. Silver getting back to its all-time highs and likely pushing to new all-time highs. Let's take a look at silver here. But gold, this chart, the overnight chart in gold gives me a sense that there is some pretty powerful accumulation happening. This is a combination of different factors, but in essence, this is a lack of confidence in the dollar and some of the policies that can impact the dollar being expressed in the price of gold. Silver trading around $48 an ounce. Similar look as gold, though. It does have this pretty powerful bid, although I say silver comparatively looks a little bit more fragile here, just in today's tape. Some more aggressive selling, trading below the point of control. Relatively large bid coming in below. And I do need to put in this add-on to show the outside liquidity. But when you see a bid of, 60 with something that has an order book of like 6,000, it's still worth watching. It's like 1% of the book right there on a single bid at 48. And then another 1% at 48.5. So these are two levels to watch carefully as long as that liquidity exists. And we've got Bitcoin on screen here, recently making new all-time highs around $125,000 an ounce, or a coin. I said an ounce for Bitcoin. That's great. Gold and silver on the mind, but there is nothing tangible about Bitcoin. It really is just ones and zeros. Nevertheless, it does have the artificial scarcity element that gets folks excited. And so here you are seeing Bitcoin bump its head, so to speak, against this point of control, rejecting for now, but I think it has room higher during today's session. The way this thing is trading is pretty constructive. Let's get back to the S&P. We've got less than a minute away from the market open. And we are just right at our weekly pivot here. And we have a market that is open. We're going to take a look at it through several different views here. One of which is I just like to watch the BGL, or the big green line. I'm going to be adding a plugin to Bookmap that is able to draw this on screen pretty soon too. Just something I'll build and give away for free. There's going to be some new free plugins I'll give away for Bookmap and Motiveway pretty soon. It'll be pretty cool, but we can just see on screen here, this is the BGL. Tested it, we got a bounce, but we do want to see price remain above that BGL. See a little bit of passive iceberg selling going on here as well. At 125. And that was right there at our weekly pivot, that sell. So there are other folks watching these levels just like we are. And you can see that weekly pivot just around key one. That is no coincidence. We really are looking at the options generated information to give us the data to build these pivots. And sometimes we're at levels where prices haven't explored these. And so, yeah, we did get a bid right off those lows. That was a pretty decently aggressive sell. That delta volume on that sell kind of pales everything we were seeing pre-market. But nevertheless, there's a bid coming off that, and it is also pretty aggressive. And we are pushing above that weekly pivot here. Still seeing some passive sellers trying to layer in on top of this. We saw this yesterday as well, particularly in the afternoon session when there was a large overhead offer. We just saw kind of iceberging and other sellers just kind of having their resting orders up there. So you could imagine there might be some supply, some profit taking after such a phenomenal run. But at the end of the day, every morning when we open up and every day as we get closer to the close, there is just an enormous cross current of institutional order flow. That's one of the reasons it's really worth watching the opening range, because it's kind of like giving you a very simplified version of just how much of that order flow is moving price around. If it gives you the opportunity to expect some more volatility, maybe potentially a trend, that's kind of what I like to trade. Personally, I really love trend days. Those are the most fun for the way that I trade, because I really key off momentum. That's not to say that I can't trade a consolidation day. I just don't enjoy playing market ping pong as much as trading the trend. And so even with that passive selling, you still have enough demand to push price higher. So looks like some of that passive selling that we had at the open is wrapping up here, and we're starting to see buyers take better control of the tape. You also had a pretty strong passive bid, 383, and then another 133 on the iceberg buy side. Let's take a look at our friend the NASDAQ here. And if there's any stocks or charts you'd like me to look at, you're welcome to drop them in the chat. If you have any questions, you're welcome to let me know. I'm just going to go ahead and look through the chats now. I've got someone asking about Tesla. So I'm going to pop a stock chart for that, and I'm going to see if I can get the options chain on that one as well. So give me a moment to load that up. And then I'm going to go through some of these questions as it does. Got two questions on Tesla, actually. All right. So Adam Warner asks about Bookmap and the SPX options visualizer. So Bookmap is awesome. I would say that for short-term traders, it's a really helpful tool to be able to see where the liquidity is in the market and how it may move price. The SPX options visualizer is available right now. You can check it out at traderade.com/SPX. So that would be, let me just type that to Adam too. So you can check that out. There'll be options visualization tools for NDX or the NASDAQ index, QQQ, SPY, IWM, NVIDIA, Microsoft, Google, etc. very soon. I'm working on basically building out this tool to be available for all of the most popular optionable assets out there. But it is a separate service because I'm going through with the algorithm I built and analyzing 10,000 options across the S&P options chain and for all these different options chains. So it does require a fair amount of programmatic effort to get all that information out there. And it's updated throughout the day. It's the only options tool that creates that frequency and granularity of updates in the levels and the flow. So it's pretty cool. All right, so let's talk about Tesla real quick. First, here's Tesla on a longer term chart. You can see it's bumping its head on this channel. I would say that could be some resistance. We've got some support here at the EMA 21. I am skeptical overall because I don't think the company has addressed the core reasons that it had this kind of decline. There is a slowdown in sales. The most recent sales reflect people pulling forward future demand as the tax credits are set to expire. So I do think that's pretty troublesome for a company that really generated a lot of its profit from those tax credits and was able to pass on discounts to customers as a part of tax credits as well. I do think there's still a chance. I mean, you can't really bet against Elon Musk for too long. He'll always find some way to push his stock price, even if the fundamentals are going the opposite way. So I don't like to short Tesla that much, but I do like to kind of watch it from afar. It is a fun momentum trading vehicle. If I was long it here, I'd probably be looking at closing out some positions because we're getting quite close to its recent highs where I'd expect there to be some supply again. So that's my thoughts on it from that perspective. Let's take a look at the stock here today. You can see it had a drop right off the open. There was a bit of pressure off the open. We saw that in the S&P 500 futures as well. But now it's breaking out and continuing higher. And you can see there are some areas. A lot of these areas are implied by where the options positioning is in Tesla. But there are some areas overhead where there's some pretty considerable interest. So you've got that at 460, 465, and 470, where you've got 115,000, 66,000, and 105,000 on offer. So while I may not be the biggest Elon Musk fan, and I may have some skepticism about the health of Tesla right now, given some of the things we've just discussed, it's hard to argue against the momentum and the options flow that is typically driving Tesla. It doesn't necessarily correlate with the stock's fundamentals. In fact, some folks have said that Tesla often trades inverse to its fundamentals. So take that for what it's worth. But this is an area where I expect there to be more supply and some potential resistance coming in overhead. And give me a second. I'm going to try something here. Well, looks like I might have created an issue with Bookmap because it's giving me a warning and not letting me close it. So I'm going to have to close the program real quick and restart it here. Give me a second. But I was going to look at adding the Tesla levels to the screen there. So let's see if we can get that going. Now it's still being a little fussy with me. Sorry about that, folks. I will get that going for next time, though, so that you all can see some of the things we're doing with that visualizer on individual stocks, because that's the next leg of the journey, and they have a similar effect on individual stocks that they do on indices and ETFs. That is to say, looking at the most active calls, the key gamma levels, and so forth can be a really helpful indicator for trading that flow. And we are pretty close to starting to see some of the options flow coming in from CBOE, impacting SPX, impacting NDX, and some of the other optionable assets. So I'd give that several minutes, but that'll give us a sense, in addition to the 20-minute opening range, as to how dynamic this market may be today. And a random question from X, from Sandra, where are you living? To which I responded, yes. So really just this is a market that is still in its decision mode. We're just consolidating around the weekly pivot on the S&P 500, which I think is going to be a pretty decisive level to watch. Remember, that was around 67.99. It's based on options derived information. And it's an area where there's a lot of call exposure overhead, so it could be an area of resistance. So far today, certainly playing that role, which is why I've made it a pivot, because I want to see us build acceptance above it to give me confidence there's room for continuation higher. Seeing some passive selling coming across the tape here. And as far as the opening range, we've only got 15 minutes of the 20 that I want to see, but it is a very narrow range so far. Market's got about 5 minutes left to show us some more dynamism, some range expansion. Otherwise, could end up being a bit of a boring day. And I'm going to just switch views real quick to show that we are getting a bit of a bearish fair value gap on this candle. So I would not want to see this cross below the BGL and build some acceptance that these bearish fair value gaps tend to be a sign of seller aggression, just like the bullish fair value gaps tend to be a sign of buyer aggression. So you start to see these building up. It gives you a sense that there is some room lower. We do have the midpoint coming on screen with early flows, suggesting that options flow is balanced so far, giving us another sense that this could be somewhat choppy if that continues. So if we zoom out a little bit, we could see that pre-market, there was a lot of consolidation. We made a big push higher from about 8 a.m., a lot of aggressive buying, and we're seeing some of that momentum stall. I'd still like to see us build above that 67.99 pivot and continue higher, but this may end up being more of a low energy consolidation day given how narrow the opening range has been. This is like a 8 handle opening range, so if it remains that way, it's not very likely that I get too excited about wanting to trade this tape. We do have a pretty decent distribution in strikes so far in the SPX options visualizer, but I'll note this is very early flow. We need a little more data to get a better sense as to where there is interest in both the most active puts and calls. And potentially strong support below us here. You've got a confluence area between the point of control, the put wall and vol trigger, and VWAP, which is this horizontal white line near price. And we're just testing around the weekly pivot of 67.99. So sort of in the decision zone right now. And folks, I don't like to force trade, so I'm not going to sit here and chop myself up in a market where it's still trying to decide what it wants to do. As I said earlier, I really enjoy days where there's a trend. This doesn't look like it's going to be one of those days, at least yet. Given the narrow opening range, given the balanced options flow, seems more like it could be a consolidation day, consolidating some of these recent gains, which is healthy, but it's not super exciting for us if you're trying to day trade it. And there's a whole other reason I don't like forcing trades, especially live in front of other people, because it may encourage you all to do the same. And the last thing I want you all to do is spend money on commissions to put on trades that aren't going to be helpful to you being a better trader or to making money. Forcing trades is dangerous. Yes, it feels good to have skin in the game. It's that adrenaline rush, that dopamine cycling when you see the profit counter going up. But if you don't know why you're getting in the trade, if it doesn't fit your system and it's not likely to win, there's no point to it. Real trading is about sniping, finding those asymmetrical opportunities where reward outweighs risk and you can execute, get in, get out of that trade, and go on with your day. So far for me, the way I trade, I have not seen that set up yet. We're just closing in on a 20-minute opening range that is pretty darn boring, around 8 handles. And we talked about this a little more on the other chart. This is the motive wave chart I was telling you about. We had that fair value gap that was bearish. Said I really didn't want to see it push below the BGL. We are starting to see that. We're also below our weekly pivot. So we're getting a bit more of a bearish look intraday on the way this market is trading. And you're seeing some of that downward continuation. 6786.75 pivot coming into view near the put wall, vol trigger, point of control, and VWAP. So could have some support not too far below us. And we're starting to see some of this flow come in as well. So let's zoom out. There is more interest in calls and there is some passive bidding here. Let's see if that continues. That could make things a little more interesting. And that distribution between the most active call and put strikes around 100 points. That's also more interesting than what we're getting from the opening range. A little bit of passive bidding here, about 226 iceberg buys going on over the last few minutes. Puts rolling higher here. So you're seeing the distribution of most active strikes compress a bit. We were just at about a 100-point distribution. Now we're at about a 50-point, 40-point distribution. Obviously, the call buyers are looking for higher. They're about 3-to-1 versus the put buyers. So that is a magnetic pull we can't ignore. But we've got to build acceptance above that weekly pivot of 67.99 to have a better chance of seeing that realized. Go back to that motive wave chart for a second. You can see there's still some continuation below that BGL break from that original fair value bearish gap. And there should be a decent amount of support down here around this warm put, point of control, VWAP confluence area. So I'm not expecting a ton of downside here if we get any continuation. Really would have to break below those levels and build some acceptance. You do have someone interested in that outcome. You've got 303 on bid at 67.80 here. But you can see sellers have kind of lost their mojo. There's not any aggressive selling happening here. Nothing like what we saw earlier. You're welcome, Adam. Seeing some big sweeps into gold again. Yesterday we saw about I would think it was several $1 million sweeping into the 415 calls for gold March GLD. Now we're seeing sweeps for the 367s just out of the money, over $1 million paid, really right off the open. And these are for strikes that are for October 20th. So it's really 2 weeks away. So still a lot of interest. Let's just quickly check on our favorite shiny metal. Gold coming down off its earlier highs, but still maintaining above 4,000. Wouldn't you know it, that point of control right at 4,000. And we talked about this a little earlier, expecting some consolidation. That gold was positioned to potentially move higher, but after such a big move, we could see some consolidation before it really continues. Similar look in silver here, just sort of consolidating after the open. Bitcoin dropped quite a bit off the open here, now down to 123,620. And back to the S&P futures, just grinding around that weekly pivot. Seeing put flow pick up just a little bit, but call flow really aggressive here. This is starting to look like a market that's going to get dragged to the hot call again. So we often talk at Traderade about the church of the hot call, where we're humorously basically making the point that almost every day when the calls are trading in significant excess versus the puts, you get dragged up to that hot call, that church of the hot call. And today may end up being one of those days. Look at the 4-to-1 flow between calls and puts. There's a lot of aggressive buying happening here. Sellers also kind of giving up. They had a chance to push this thing lower, and they came right into that sort of support confluence zone we had talked about earlier, and they seem to be giving up. So it may end up being yet another day where options rule the day, at least giving us maybe room for 30, 35 handles higher. That's the most exciting part of the market generated data that I'm seeing. It's certainly not the 20-minute opening range. It's really where that distribution of flow is, the 4-to-1 between the hot call and the hot put. That's the most active call versus the most active put on the S&P 500 index. That gives me a sense that there's some magnetism up there. That's the most exciting part of the data we've gotten from the market so far this morning, is the options flow from SPX. And folks, if you're interested in picking up a copy of Bookmap, you can get up to 40% off. Visit traderade.com/bookmap. And if you want to check out the SPX options visualizer, that's available as well. It's an add-on for Bookmap as well as MotiveWave. You can grab it or even learn more about it at traderade.com/SPX. If you'd like to learn more about what I'm up to, simply visit traderade.com. Got a Discord, a great community, lots of awesome trading tools. My baseline feel for today is it's going to be choppy with the path of least resistance being higher. That's what I'm getting from the flow. It looks like a market that wants to consolidate, but there's this magnet up here that we can't ignore that could just pull us right into the hot call, especially towards the later part of the day. And one thing that's interesting, we were looking at that BGL before. We have pushed back above it, and now we're starting to build some acceptance up there. We'll see what this next candle does, but if we can stay above there, that is starting to look a little bit more constructive to a bullish outcome in a scalp time frame. That's the 21 EMA on a 5-minute chart. If you want to create your own BGL, it's actually been pretty helpful as a momentum tool. Very simple moving average, but it can help guiding your trading intraday. See, we're still not able to quite get above there. Looks like we're going to go back and explore some of these lower levels. But what I like to see for a BGL break above is you get a candle that closes above it, and then the next candle holds above it. That really validates it. We're not getting that second bit yet. Still, again, that weekly pivot, really a level that the market has to think about a lot. That was 67.99. You can see we are just chopping around that pivot for much of this morning. So that's something to watch. Look at that weekly pivot this week. If we can break above it and build some acceptance, we've got room for continuation higher. There is a call wall above. We've talked about how these options levels are really important. This is around 6,800. There's this roll up happening. Larger institutional traders are rolling up their positioning in SPX. 6,800, 7,000 coming into view too. A lot of positioning rolling up to that strike. So ultimately, the larger desks are looking for this market to resolve higher. But before it does, it looks like we need to consolidate some of these gains. So I want to thank everyone for tuning in to this week's episode of Back to Futures with me, Markets and Mayhem. I'll be back next Tuesday at 9 a.m. Eastern. If you'd like to learn more about what I'm up to, visit me at traderade.com or check out my Twitter feed, Mayhem for Markets. Talk to you soon.